The Fed is hiking what's called the federal funds rate. This is intended to slow down the economy, to quell the biggest problem that we have out there, not just in the United States, but across the globe, which is inflation. The cost of goods and services is going up. You guys are feeling it, whether you go to the store, you go to the pump, things are costing more. Our dollar does not go as far. So the Fed has dedicated themselves to fighting this inflation at any cost. Well, when the Fed hikes, it does a couple things. It makes borrowing costs more expensive. Credit cards, car loans, it causes our treasuries to go up. It causes small business loans, personal loans to go up. And what they're trying to do is literally destroy the demand side of the economy to help reduce this inflation. It also has a bad impact on the markets. If you look at the stock market and equities, when the Fed hikes, it causes borrowing for businesses to go up. They can't expand as much. It also causes the dollar to increase. Now, that might sound like a good thing for goods that we import, but goods that we export, and we're very much a net exporter, they cost more now to foreign nations because the dollar has risen in comparison to their local currency. Well, that means that half of the earnings of the S&P 500, which is now overseas, well, that's probably going to go down because now we're not going to export as much business and our U.S. companies here are going to suffer. So when the Fed hikes, you see stocks usually go lower. Now, counterintuitively, if the Fed is able to achieve what they're trying to do and get inflation to move lower, and we'll go into that, you actually can see mortgage rates come down because they are most closely following inflation. So let's get back to this article here. So Nick Timiraos, the Fed mole, basically every time before the Fed has a meeting, and the next one's coming up November 2nd, he comes out and lays the groundwork for what the Fed is expected to do because the Fed does not want to come out and say it themselves, but they also don't want to shock the markets. Now, we already knew that the Fed was going to hike 75 basis points on November 2nd. That's been pretty clear, but this 100% confirms it. But the question is, what is the Fed going to do at their upcoming December 14th meeting, which is the next meeting? Now, if you look at the futures markets, they were pricing in a 75 basis point hike. But something new that we've been seeing is that the Fed members, some of them, are now concerned that the Fed is doing too much too fast and they are destroying the economy to too much of an extent. Here's the thing. When the Fed hikes, it's not like right away you see the impact. There could be a 6-month lag. So what some of the Fed members, including the Fed vice chair, who's very important, Lael Brainard, said is, hey, maybe we should start to slow the pace of this and then also begin thinking about stopping rate hikes sometime down the road here. This was new information that we're getting here. And Nick Timiraos basically coming out and saying that many of the Fed members now think maybe we should hike 50 basis points in December as opposed to 75. Now, the market saw this and they loved it because, as I mentioned, stock market doesn't like Fed rate hikes. Now, when you also see what the Fed may do, they want to keep their credibility because the Fed has basically said, listen, we are going to get rid of this inflation. So if the markets were expecting in December them to hike 75 basis points and they do 50, well, how can they get away with that and still keep their credibility? Well, Nick Timiraos suggests that maybe they can approve the 50 basis point hike, but then they can use their economic projections to show potentially some future rate hikes in 2023, more so than they had previously stated.